most of the oil and gas world, just mega projects, mega deals, really incredible opportunity. And that's really where I learned about M&A. And then I had a friend, Brad Marvin, who was working here at Fourpoint Energy under George Solich, and Brad and I had actually worked together at Petrie Parkman, and so that Petrie Parkman
Okay.
story continues.
There you go.
And when George Solich was thinking about getting into the mineral space, Brad suggested that George reach out to me. No, Brad knew that I had done the minerals thing for a couple of years prior to joining Petrie Parkman, and the experience that I had in the M&A group and Shell really sort of paired well for what George was looking for. And really, the first few conversations that I had with George were less about an interview or even really what I was looking for was more about helping him understand what it would take to be successful in the minerals business. He had a pretty good idea. They had actually picked up some minerals in, I believe, Cordillera 3 through their leasing program. Just as they were out there leasing, they had folks saying, "Hey, will you buy my minerals?" And so that's really sort of where this idea for Long Point came from. But really, those early conversations were a lot of tactical questions around how to get sellers to sell, what we thought volume would be, what the hit rate would be, how you'd need to staff that out, what that would look like. And he had a vision already, but it was really kind of sort of rounding that out and testing some of those ideas.
And for those who are not familiar, you have Fourpoint Energy, who's the sister company of Long Point Minerals, E&P focused, and then you guys share offices, share technical support and resources, and then you have Long Point, who does a lot of the minerals acquisition. That kind of partnership structure or sister entity structure is something that's become a little more common in today's mineral space. Where did that idea kind of come from? I know you guys weren't the first, but Viper, Diamondback, they've been a pioneer in a lot of different structures and trends in the industry. Was it that kind of got George thinking? Was it really just the conversations with the mineral owners in that leasing program with Cordillera? Just kind of curious how it all came to fruition.
Yeah, so that's pretty interesting. I think it had less to do with trying to model an existing structure, and it had more to do with really trying to bring the entire E&P skill set to the mineral space and bringing that technical prowess, the technical know-how and understanding, bringing to bear the larger organization of accounting and land administration to really apply those things to the mineral space to be successful. And I think that they really were striving to run in the mineral business more like an E&P business and less like, I think, a lot of examples that they had seen out in the field. In many cases, I think, certainly, like you said, there's some other players out there, but in a lot of instances, we've been able to have an advantage for a while now.
And now here's where you're unique, and this is what I'd love for you to talk about. Long Point 1 and 2 in the fundraising side. Your major LP and the primary investor is Canadian Pension Plan. That's where you guys are unique, right? If you're going to look at others who have the E&P royalties arm, others are doing it with traditional private equity. You guys have a very cheap cost of capital, and you're an end buyer. You're not looking to exit this in the future, and so that gives you a big advantage on top of the technical expertise and leveraging the E&P platform, if you may. Can you go into that? I'd really love to hear that. I'm assuming George and your team approach Canadian Pension. It's something that this is one of the main reasons we're doing this podcast, because there's a need to get more pensions and more endowments and sovereign wealth funds and foundations and investors that have this patient long-term capital to become end buyers, and they can buy up and down the value chain. They don't necessarily have to put billions of dollars to work like you guys have, but it just makes sense. Can you, I'd love to hear the evolution of when you were doing the dance with them on, did they get it right away? I know they're very sophisticated oil and gas investors. We know Avik Dey's team very well. I know you guys are dealing with a different entity within Canadian Pension for Long Point, but just some insights on, how a pension fund views this space.
One of the things that George recognized very early on was that minerals is a long-lived asset and a long-term asset. It's a yield-based asset, really fits an investor who's looking for yield and cash flow, and doesn't necessarily fit a lot of the private equity models. I think with uh, this public space in particular still expanding, there aren't a ton of exit options, at least for larger mineral packages. And so a group like Canadian Pension Plan, a traditional LP investor, is very well suited for the mineral space and making mineral investments. Um, when the guys first got started, they were using Jeffries to make that introduction. I think Jeffries was very instrumental in getting us our foot in the door, and then obviously George is really good at helping investors understand exactly what the proposition is. And I think through that process, they were able to really explain to Canadian Pension Plan and help them understand just the opportunity that was before them in the mineral space. I think one of the challenges, and it certainly has started to change a little bit from an LP perspective, is what we've seen and what we heard when we were out on the road a lot of times was that LP investors sometimes have a hard time making direct investments, and they're much more comfortable making investments with asset managers who are then making the investments for them across a portfolio. And a lot of these LPs aren't even really set up or structured in a way to make direct investments. Now, we've seen a little bit of that change, and obviously you've seen more and more folks starting to come to the table for direct investments into yields, cash flowing based assets like minerals. But there's still a lot of room to go there. I think that there's still quite a few folks that are more comfortable just making investments with asset managers than they are with direct investments into companies. Now, the partnership has worked out phenomenally well. Canadian Pension Plan is our anchor investor, as you noted, in Long Point 1. And then when we went out and raised Long Point 2, they were an anchor investor again. They've been an incredible partner, and we've worked really well together. And it's worked out really well. It has been a good cost of capital for us. It's allowed us to capture a lot of deals. But I think beyond that, just the partnership in general works extremely well. We haven't had instances really of us being misaligned in terms of vision or where we want to take the company. So far, everything's worked out really well.
No, that's fantastic. Just for color, if you're comfortable sharing, just a size on your funds, just so people have perspective. I mean, we're interviewing CEOs of all size companies on this podcast. Some are managing $5 to $10 million funds, some are 30 to 50, some are a couple hundred million. I mean, you guys are at the top of the pyramid, right? So just a little bit of color on the size. And then, I'd love for you to kind of go a little bit further on, LPs investing directly. And you said some of them aren't structured to be able to do that. And you said that's changing. Can you go into some of the change? Are they setting up, side entities to be able to do this and have a little more flexibility? The argument for royalties companies is, why would you pay management fees in a fund when you can own these directly? And one of the biggest misconceptions out there is that this is going to be a really complex, difficult asset to manage. There's a lot of complexity and expertise on the industry and the technical side needed to acquire and assemble a portfolio. But if a team like yours does that, a lot of the hard work is done, and then it can be managed directly. It's just a financial management play, right? Managing cash flows and making sure the accounting's straight, sorted out, and that can be outsourced, or it can be done by a team like yourselves. I mean, the other thing, when you say direct, I think a lot of minerals companies out there, especially lower down the food chain, they talk about turnkey packages and selling direct to where, a pension or endowment would hold it directly under their own AUM. Do you think that's possible, or there needs to be, because right now Teachers Capital, another big Canadian pension who's investing heavily in the space, has Heritage. Canadian Pension has Long Point. Do you think it's just more realistic for them to directly invest in a company versus own the assets outright on their balance sheet?
Yeah, no. a couple of questions there. Let me start with your first one. So, in terms of size, we raised over 800 million for Long Point One. We deployed that in about 18 months, then went out and raised Long Point Two, which was again over 800 million. So we raised almost 1.7 billion total between the two entities, and we've put a good portion of that to work. Long Point One is now just in distribution mode, so it's no longer making acquisitions. It's just returning cash back to shareholders. We're still deploying capital in Long Point Two, and as soon as we're finished with that, it will then also go into distribution mode, and we'll go out and raise Long Point Three. I think, yes, when I say it's changing, I think that, you know, certainly there are folks that are not set up to own direct investments for a variety of reasons, and we've seen it kind of vary from, different pension plans to insurance companies to family offices on the reasons why. Some of it is they don't want to take certain risk or perceived risks internally by making direct investments. Other ones just can't manage really direct investments. They really can only manage putting money with money managers, and there's a variety of other reasons why a direct investment wouldn't work, and why that landscape is changing. I think that the way that folks are getting that solved is a couple of different ways. You mentioned sort of side investments and sidecar deals. I think we've seen some of that. That certainly is one way that these LPs are tackling it. Another way is that they're just starting to hire the people that are necessary in order for them to make those direct investments. So, I think it just sort of varies by the different LP entity and really how they're going about trying to um, incorporate direct investments into their portfolio, and what they're doing to really sort of tackle that and address that. Um, in terms of, seeing other folks, like you mentioned, we have Canadian Pension Plan with us, teachers with Heritage. I think that in terms of the type of direct investment, in other words, owning the assets directly versus still just putting it with a management team or a company in order to just manage the assets. I think that a lot of people believe that minerals are a very low maintenance asset, if you will, to manage, and that you simply make the acquisition and then you collect the check and it's mailbox money. You certainly could manage your business that way if you wanted, but you would leave an enormous amount of value on the table. It actually takes quite a bit of work from a land administrative perspective and an accounting perspective to make sure you're tracking down the revenue that you should be getting, checking the interest on the assets that you have, and that you're being paid when wells come online. I mean, operators in general are not very incentivized to make sure all of that is correct and to pay you. Operators also have tools at their disposal that allow them to delay paying you when wells come online, so they don't have to pay you right away. Typically, there's anywhere from a 3 to 6 month delay on that. And that can be very cumbersome if you don't know what you're doing, if you're not familiar with the space, you aren't familiar with title, with some of the accounting procedures, how the operators work. So you need to have that understanding. You need to have a small to large staff of folks, depending on the assets, to manage all of that. You're going to be getting division orders. If minerals go open, you need people that have leasing expertise that go out and lease those expertise. And when wells are being drilled, you want to have a technical staff that can predict where operators are going to be drilling, to help you understand when wells are drilled, what the production profiles look like. So there's actually quite a bit more, I think, that goes into it than a lot of folks initially think about. I think initially they just think, oh, I go out and buy this thing and I'm going to collect a check and I can kind of forget about it. And there's really a lot more to it than that.
Yeah, and so actively managing a portfolio, there's value there. And so I guess kind of summing up those questions I asked, having these entities directly invest into a management team is probably where the space will go, right? And then if, like you said, having someone on, they don't have to be experts, but they could have someone with the industry experience to be able to, be a sounding board or a checkpoint, right, on everything, make sure it looks good. That's really helpful. So 1.7 billion, that's tremendous. That's a lot of money, and you guys are just one of many companies out there. it shows how big the space is, and you guys are deploying it at a very quick rate. So there's lots of upside still to go. Can you talk about the other types of fund companies, investors that are in your funds? It just to paint a little color on, we're going to be distributing this podcast to all sorts of investors, generalists, people outside the industry, real estate, all sorts of different institutional investors to try to get them interested in this space. So if they're listening, kind of touch on the different classes of investors so that they might say, oh, the yields and everything are appealing to me. If others in my other, my investment peers are looking at this, maybe I can dive in a little deeper as well, right?
Yeah. I think most of the folks that we have targeted when we went out and did our fundraising were sort of your traditional LP investors. So that's endowment funds, pension plans, insurance companies, family offices. Those are really the types of folks we targeted, and the folks that we have in our equity stack. We have representation from all of those groups that I just mentioned. When we went out and raised Long Point 2 in particular, we did show it to a lot of more traditional private equity funds, but it was just harder for them to get their arms around the structure and this idea of, holding on to this asset for an extended period of time without necessarily having a specific exit in mind. And I think certainly we would look at opportunities, but like you said, we're a long-term holder. Canadian Pension Plan has been very happy, along with our other investors, with the distributions we're making out of Long Point 1, and looking forward to the distributions we're going to be making in pretty short order out of Long Point 2. And I think company or investor that this really appeals to is somebody that is searching for yield. This does not fit, I don't think, somebody who's looking for a quick flip or a large pop on an asset sale, maybe on a much smaller scale. So certainly there are mineral companies out there that target that market because their business plan is one that they're trying to aggregate packages and then turn those quickly to larger buyers, either like us or other folks. And so maybe in that business model, more traditional private equity or a different type of investor that's looking for more of that quick pop or return on a sale fits. But for us, it really comes down to somebody who's looking for yield cash.
Gotcha. So I got a question for you. So you sit down with an LP investor, and let's just say they've invested into oil and gas, in particular upstream, over the last 10 years. More than likely, they've had a rough go at it, right? The returns for upstream haven't been as frothy as they may have been in the past. And so you've probably come across some people who are a bit jaded on the oil and gas space right now. Now, minerals and royalties are tied to oil and gas commodities, but it is a different play. I've heard clients refer to it as very bond-like. You don't have exposure to cost on any operations or infrastructure. You get free upside exposure to technology innovations. Right? There's a number of positive spins on investing in mineral royalties, and you can talk about that. But what happens when an investor says, "Well, Will, this all sounds great, and I see a lot of capital's flown into this space. You've deployed a lot, you've raised a lot, but aren't you making money on increased production?" And so if capital is, it's stringent on and it's being very careful on going into E&P development to further drilling and thus increase production, which increases royalty payments. If that capital is going down and I'm investing in minerals, don't I need E&P investment to drive minerals growth? And it's a bit of a catch-22, and I think it's something right now where the industry is really good at reinventing itself and finding creative financing solutions. But when that comes up, and you can kind of put your Fourpoint hat on here, how do you go about combating that and hedging that risk? Is it following, buying minerals only under very, very strong companies with balance sheets that are healthy, that have very, predictive rigs and drilling plans, rig schedules and drilling plans, I should say, going forward? Would love to kind of hear your thoughts on that, because it's definitely something that an investor is going to have to think about, because they're tied together, EMP development and minerals cash flow, right?
Yeah, no, certainly. And I think you're touching on something that I think a lot of folks overlook sometimes when they think about the mineral space, and that you almost see a disconnect in some instances when you look at, how people are thinking about minerals in certain instances, that, the minerals is certainly tied to EMP, and the EMP development is necessary in order for the minerals to get value. And one of the biggest drivers on that is going to be development timing. And so you need development to happen. You need to receive the cash flows, the wells to be drilled. But that doesn't necessarily mean that you're willing to just take whatever sort of production comes your way, or that you're just solely focused on volume. I think for us in particular, the timing of when we launched really worked out in our favor. And we launched in mid 2016. So, the industry is kind of coming out of that downturn in 2015. What that really did is help de-risk for us where to put our money within the US. And as we looked across the landscape in 2016, there were only two plays at that time that were really making any money, and were the only places that operators were investing capital and continuing to drill. And that was the Eastern Anadarko Basin in the Scoop, Stack, and Merge, and then in the Permian Basin in both the Delaware and the Midland. And so, that's what we really saw. We looked across and said, well, those are the only two places where there's rigs. There's the only two places where operators seem to be making money. Let's focus in on that. And so we've always sort of taken limited basin strategy, and for the most part have been just a two basin strategy, focused in on those areas that we knew operators could continue to make money even in a low price environment. So that kind of gives you the where and how we chose where we are. I think the other thing that you touched on is very critical, which is around operators' ability to continue to develop the assets. I think that today is actually becoming more and more prevalent. In this downturn, we certainly are seeing some operators struggling and trying to continue to make things work, trying to remain profitable, trying to continue to drill wells and just stay alive and just stay relevant within the industry. So it takes an additional layer of research there to really go beyond just, is the operator you're buying under a well-known operator, to really uncovering and saying, okay, do I believe that this operator in the future will have the financial capabilities and the balance sheet to continue to develop and produce the asset? It doesn't do you any good to buy under somebody who maybe at the moment has a little bit of cash and is drilling some wells that are uneconomic. That may sound great as a mineral owner because you don't have any capex or opex, and you could think to yourself, well, what do you care? You can just buy under that person and get the minerals. But if that person can only afford a couple of wells and you own a vast position and you need them to drill a lot more than those couple, then certainly you need to look at the viability and the financial capabilities of that operator. And that's one of the things we take into account here. That is, just like you said, we put on our operator hat. We really dig into things from the financial side to really understand, not only is that operator maybe a great driller, maybe, they're drilling wells quickly or they're completing wells better than other people, but do they have that financial capability to continue the development program? Because like I said, that development lever, that development timing is one of the most critical when you're looking at valuing these assets. Typically, you can be off a little bit here or there on your type curve. You can be off here a little bit there on some of your other technical assumptions, but one of the biggest drivers is going to be development timing. If you miss that in a big way, then you really potentially have a lot of money just sitting in the ground. And what I like to refer to as just dead money. I think with minerals, the risk is a little bit lower because you hold it into perpetuity. So it's not like it goes away. And if development timing gets delayed, certainly it just pushes your return out or minimizes your return. I think having gamblers ruin in the mineral space is much lower than, say, in the E&P space. But you still have to be careful. You still need to take a look at what's happening more broadly than just it being good rock. And
Yeah, I mean, I
yeah.
I got a question though. So you guys have the one of the cheapest forms of capital in the mineral space.
Mhm.
What about the theory of you are holding this into perpetuity. You can obviously buy stuff cheaper when it's undeveloped, and if the rock is good, you can have the idea that it will get developed at some point. Is there a bit of mix in that, and how you're building your portfolio, and then you know macro implications? You worked with Tom Petrie. He's one of the most renowned economists and revered for his global perspective on how the space is going to develop and the trends that are going to unfold both from a industry and a financial perspective, right? So I'm sure you have that part of your brain ingrained in you just from working with him. I interviewed Darren Zanovich the other day from Mason Minerals Partners. One of the reasons they're very bullish on the Haynesville is because they see that as being one of the main feedstocks for LNG in the Gulf Coast, and that being LNG being a major driver for the U.S. when you look at energy security and the economy and everything going forward. I thought that was really smart. Do you look at things from a macro perspective like that? Because if you guys are so long term, but you're only looking, not say only, but if there's a heavy focus on that development timing, that's more nearer term, right? How do you balance both?
Yeah, so that's a great question. So we really think of ourselves as portfolio managers, managing this portfolio of mineral and royalty assets. And so in managing that, what we're trying to build is we're trying to build a cash flow and yield profile that has near, medium, and long-term growth. Now, that doesn't mean that we're only making acquisitions that fills all three of those buckets. Certainly make acquisitions that only have one of those buckets sometimes. Maybe we look at a PDP heavy deal. Maybe we look at a deal that doesn't have any development on it now, but it's got it out in the future. But we're constantly looking at the portfolio to make sure that we don't have any parts where the projected yield is just sort of falling off a cliff, if you will, and dropping. What we want to see is a nice rampy growth profile that continues to provide yield and cash flow growth back to our investors. We're really trying to build a durable, sustainable business that way, and that addresses exactly what you're talking about in terms of, being short term, medium, and long term focused, and having the cash flow that sort of fills all of that, and really providing not only something in the near term but also for the future. And I think that's what gives us flexibility. If we were constrained in some way, and like a lot of the publics are, I think a lot of the publics struggle because they need to do deals that are cash flow accretive, that have a certain profile, and so all of a sudden that starts to limit them down into a pretty narrow space in terms of the type of transaction that they can transact on, at least in a large scale. I think maybe on a small scale, they can do what they want, and that's not going to come up. But anything of meaningful size needs to sort of fit a pretty prescriptive description in terms of what they can bring into their portfolio, and that limits them. And I think that's also where private equity, private companies continue to play, because private companies can put things together in any manner of form. So, grab stuff that's long term only, grab some stuff that's medium term, get some stuff that's short term, kind of cobble that together and have it fit the profile that those publics need, and continue to feed the machine, because the publics really need acquisitions in order to continue to grow. And so that's where I can see a private player continuing to play. But we certainly take a look at the macro picture as well. You talked about Tom Petrie. Always love to hear what Tom has to say, and definitely from that, look at things from a macro perspective. And again, that's what really helps us sort of put together this portfolio that has, both a short and long-term view. We're taking both of those things into account and really trying to build a portfolio that way.
I want to pivot a little bit, and then we can kind of draw the interview to a close. Let's just kind of talk your portfolio, where it is today. So you guys are focused on the Anadarko Basin, right? The Scoop, Stack, and Merge, the Midland and Delaware basins, and you're also looking at the Eagle Ford, correct? Can you talk about kind of how many deals have you done, the size of your portfolio in terms of net royalty acres, how many deals you're looking at a year, what are the things you look at in deals that, and I guess some of the partnerships you've had. So if you've raised 1.7 billion, if you and you built a sizable portfolio and